people have got lots of questions about interest rate forecast, and I'm going to jump into this. I'm going to give you guys all a big, massive disclaimer. Always say, do your own research. Don't trust me. I'm just some idiot on the internet giving you some feedback. I'm not always right. I'm making my own bets. I'm making my own decisions. I'm doing my own research. A lot of people didn't trust what was on the news last year in the media, and suddenly they're asking questions. Oh, is Ukraine going to win, or is it going to be Putin, or is it going to be ScoMo or Alba Sleazy, or whatever the case may be, Scamo or Sleazy, right?
It's not easy with Albanese, is it?
Right, whatever it is, right? I couldn't care. None of it's right. It's all, they're all actors. The whole thing is a circus. So I do my research based on facts and figures and history and prognostication. I'm trying to calculate out and reverse engineer what a solution could be. And you asked me beforehand, Rose, do I think that surely you couldn't go up over 2 years by 25 basis increases? Firstly, the interest rates going up at the moment. Someone just asked who am I voting for in the election. People say you shouldn't talk about money, religion, politics, or anything like that over the dinner table. I'll talk about it all. I used to be a very liberal guy. I think I'm politically atheist because they're so much alike. If you had two puppets, one on each hand, right? I want to know who the puppet master is, right? Whoever creates the money is the controller. So whoever's presented to me, it's a selection. It's not an election. I can't choose. I don't have a choice. I have a selection of two people, two options. That's all you have. So I'm not really excited on that front. And I actually just want to read, before I go into this, Josh asked an interesting question, and it's very easy for me to answer this one. Would it be better to fix for just 1 year rather than 3 years? No.
Right? What is the point?
So if you're fixing it for 1 year, you might save a couple of bucks, but the interest rate's already so far higher, right? But if you want to refinance, which I know you do, your equity will be stuck in there. Secondly, when you go after that 1 year, you're going to lose all your discounts, which is going to be the 2%. You'll be paying an extra 2%. If you lose your discounted interest rate, you will literally be paying an extra 2% for the life of your loan. You're going to screw yourself up. So think very, very careful before you go to that fixed interest rate. Whoever is watching and thinking about it, do look at all the terms and conditions and do think about what will happen to your loan after that fixed rate period. Okay, this is where I pull out some charts and I share with you guys some interesting commentary. This here is a yield curve, right? And this is bonds, right? So when you look at bonds and you look at like interest rates in different countries, whether it be, if we've got here the United States yield curve, and I refer a lot of things back to the United States, and it's not because the United States is something to follow, it is that all currency is based in US dollars. So currency is created and spent via US dollars. So if you follow this chart, you'll see three lines that go across. One is orange, one is greeny or grey, I can't even see it on my screen.
Green.
It's green like Zinger, and the other one's obviously blue. Is it pink? It's blue. PI is purple.
Oh, that's right.
Yeah. Colorblind, maybe. Women can't be colorblind. Did you know that?
Well, I am.
Are you?
No. I just don't realize the PIA is purple.
Yeah. No, it's actually a thing. It's something that's real. So anyway, going into these charts. So this chart, if we go down the bottom and look at the index here, the blue is current as of today. The green one is as of 1 month ago, and the orange one is 6 months ago. So if we look at the upside on the side, the index here is the percentage points of what is the return on the bond. And if we have a look at the bottom line, it is how the tenure of the bond. So a 10-year bond, for example, is somewhere here. That is the rate. So if you're getting a 10-year bond, the US is based in at 3% at the moment. A month ago, it was, where is it here, about 2.5%. And 6 months ago, it was based on about 1.5%. So it's shot up about 1.5% and doubled over a period of 3 months. So we look at that, that's just showing where it's changed over the last 3 months for each of these. If you've got a 30-year bond, or if you've got a 2-year bond or a 3-month bond. So this is very, very important to look at. It's boring as fuck, but it does have signs here. This here is a positive yield curve. So if you put your money away for 2 years, you're going to get 0.5%. You put it away for 5 years, you're going to get 1.25%. You put it away for 10 years, you're going to get 1.5. So the longer you put the interest or your money away, the bigger the return that you're going to get. So then we look at now, if you put your money away for, say, 2 years, you're getting 2.6 there.
Yeah.
And if you put it away for 10 years, you're only getting 2.35. So you'd be better putting it away for 2 years than you would be for putting it away for that. And then if we look at it now, it's flattening. So something that's gone here is a positive yield curve, a negative yield curve. If this was in the total opposite direction, it would be a negative yield curve. We've got here a flattening of a yield curve. What happens is when the markets implode, right, and the bond markets implode, it means that the risk is taken away and people are wanting to put their money away for a shorter period of time and not for 10, 20, 30 years. What happens is when you're getting the greater yields over here, that means that all the liquidity is flowing out of the markets from the longer terms into the shorter terms, right? And what it causes is a liquidity crisis, which is a deflationary event and a recession, right? A recession and depression. So if the yield curve is positive, it is a good economy. If it is flattening, it is going into recession. If it is negative, every time interest rate, the bonds have gone negative, we've seen a recession. So I want to go on to a few more charts. So that's just some basics of it, right? And I encourage everyone to keep an eye on the US yield curve and the Australian bond yield curve. It is changing in Australia at the moment. So just having a look here, if we look at the bond yield here, we can see it is flattening. And it is, if we have a look at this one, it is inverting. So you can see the green one is going up on the short term. This is very clear with the one from only a week. This is a week change. The shorter term is going up and the longer term is coming down, which is a flattening. And then once it flattens, it only needs to, flatten a little bit. And that, to me, is code red. Woo, woo, woo. We've got a massive fucking crash coming, right? We've got a recession, stock market's going to turn to shit, everything like that. So then we can see that that's clearly flattening out. And when it goes negative, we have a big problem. So if you note that as these things are occurring, right, if we go back to this chart here, we had a positive yield 6 months ago. Where would that have taken us? That would have taken us to October last year, sort of period, November. And then we've got, April, March, April, then we've got May. Now, what has happened is that stock markets have crashed in this period. We've got crypto markets have crashed. Every market is crashing, right? That will cause a recession, massive recession. And this is what happened back. Here's another chart, right? This is what has happened, and I will explain these charts, right? These are very important things. So take screenshots of these, take photos of them, and just reflect on this in the future, right? Because what I'm saying, I'm happy to put all my credibility on the line, and people might think I'm a dickhead today, right? But in the future, they'll be like, fuck, how did Birch predict that? Is he a time traveler? No, he's prognosticating and looking into the future and reverse engineering what is in front of him. So if we have a look here, this is a very important chart to look at, right? So this one here on the left is the yield curve currently. So this blue line is the current. This lighter grey one is May 2020, and then May 21 is the darker grey. So if we look at this looked like a fairly attractive yield curve. This here looked like a much better yield curve. So what happened, right? We had Corona, we had certain things, the market was shit. What did they do? They fixed the yield curve, right? They printed lots of money, they made the interest rates cheap, and they survived the market. So the markets responded with a positive yield curve. But when they stopped with the inflation, when they stopped with the currency creation, once they started changing the cost of the money, what has happened is that the yield curve has crumpled up and turned into a negative yield. So here we are currently, And if you had a bond for 3 years, which is paying 3%, or you're getting 10 years for 3%, it's going negative. So it is going to turn very, very bad. Let's have a look at this historical 10-year to 1-year inversion of the spread, which is the 1 year, which is about here, which we're heading up to there. This is 0, right? This is your baseline here. The inverted yield curves predict the last 7 recessions, right? 1970s. These grey lines are the recessions, right? I find it funny, right? In Australia, someone asked me who I'm going to vote for. Everyone hates Paul Keating, right? The recession we had to have, the words that came out of his mouth, right? I was 7 years old then. I knew nothing, right? I got no idea, no memory. I could just see old archive videos of this guy. Everyone says he was a prick, right? What he said was probably harsh and was probably true. It may have been an honest politician, right? He may have been. Because if we look at these are not Australian charts, these are global charts. This here is a recession in 1992. It is the same recession that occurred in every country around the world at the time. Our markets are global, they're tied to a US dollar. The amount of liquidity sloshing around the system is determined on whether things are going up or going down. If we have a look here, the grey parts of the recession, and just prior to the recession, each recession, it went under and they inverted. The yield curves inverted. The bigger the inversion, the bigger the recession. The longer the recession went on and the deeper the recession went to. So if we have a look at this, we have an inverted yield curve, and then we were followed by a recession. We had an inverted yield curve, followed by a recession. We had the GFC, it inverted in 2007, 2006, and then we had a recession in 2008 and 2009, and then we fixed it by dropping interest rates. We dropped interest rates, yields didn't invert, right?
That's the start of a low interest rate in 2010.
Correct.
Isn't it?
But each time, think about an overlap, the RBA rates, right? What happened with the RBA rates? Then we go to October 2018. We started to see the market go sideways. And I've got the next chart to show, which will look more exciting. And then in September 2019, I did a Facebook Live. I did a few master classes, as I'm going to start calling these things. And people like Birch, you're off your head. I warned about in 2017. I called it the global financial depression. And some people used to comment on my videos saying, Nathan, get off the drugs, stop snorting cocaine and all these sorts of things. I've never touched it. Imagine if I had a bag of Coke. I'd be like talking. I'd be brilliant. I've never tried it. I'm too scared of it, right? Give me dead, I'm fine. But it was funny because people were, hanging shit on me for the things that I was saying. Anyway, we saw it invert, and then we saw the biggest money print. Why did the yield curve not invert? Because we printed money and we made it very fucking cheap. What happened in the middle of 2021? We went from quantitative easing to quantitative tightening. We had a blunder in around March last year, May last year. What happened to Bitcoin? Bitcoin and all the cryptos crashed, right? We then printed more money. We locked everyone in the home, forced them to go and have an injection, and all those things that had occurred. And then suddenly the market started to take off. We introduced more JobKeeper, more stimulus packages. And then suddenly the market went up a little bit. And then we stopped it. And now it is falling off a cliff, right? As we can see here, as we're going into quantitative tightening and removal of all the stimulus packages, our economy is stuck on a cheap credit. It is like an addict, and it needs more and more to take from, it needs more food, basically. Here we go looking at the US 10-year. This is like probably the best one for you to go and look at. The US Treasury 10-year minus the 2-year spreadsheet. So this is the inversion of the 10-year over the 2-year. We saw the inversion, so we've got this line here, which is the 0 basis point, the 0 bound, and then we have over the top, this is -1, -2%. This is 1%, and this is the difference. That's the spread between, if you locked your money away for 1 year or locked away for 10 years, that's the difference between it, or 2 years versus 10 years. So in each of these times, it inverted, we had a recession. Inverted, we had a recession. This proceeds by about 18 months. But the rapid rate that we are forced to do this right now, because we're at a 0 interest rate policy, there is nowhere to go. This will cause either massive hyperinflation from them printing too much, or it will cause massive deflation. So looking here at the GFC. We can see it inverted slightly, bang. We captured it well here, right? We had it in September 2019, and then we had a recession in the start of 2020. They blamed it on the alleged flu illness out there people had, right? I'm thinking of my words carefully because I'm going to be cutting this little part out and putting it onto YouTube tomorrow. But then we had this recession here that was a blip. But if that didn't get fixed up, we would end into a massive depression, which is why I said would end up in the global financial depression. Looking at the next step here where we're at, we're almost at the next inversion, right? And they're trying to stop it, but they can't. They cannot stop this. They cannot control it. So as they push up these rates, this is going to invert massively because there's too much risk. So as they push interest rates up, we're going to see, look at what happened here. We've got the biggest recession ever. We've got the biggest recession ever. They either have to bring it down or we're going to have the biggest crash in the world, right? Ever. Bigger than 1929 stock market, bigger than anything. So the question is are they going to let it blow up or are they going to print more money? And if it blows up, the handlers of the politicians, the handlers of all these people that are in charge, the puppets is what I'm talking about, the avatars that are in the media, they're the handlers, they blow up as well. So they need this system to keep alive until they can fraudulently take everyone from this system over into a new system. And that is where we're at. And that's what this decade's all about. We're going to see the whole currency system crash and massive inflation. The only way through this is inflation. Inflate your way through because the debt becomes irrelevant with inflation. And that's where I'm at. And that's where I'm putting my money in. That's what I'm banking on. Look at this chart here is the US 10-year over the 2-year. Once again, we can go back to 2017, and I've got this chart because I want to expand and spread this out further. So if we look in 2017, when I called that we're going to have the big global financial depression, the inversion got down to around here, right? And I said in October 2018, it was the 10th of October, it was between August and November 2018, I said we were going to enter the depression. And what happened is we came so far close here, and then the market got rigged, and everybody's crypto fell, everyone's shares fell, everything turned to shit. What was happening is that they were taking $50 billion per month worth of money that they'd printed out of circulation in that period of time, and they were trying to jack up interest rates. What happened, if you have a look here, this is going down and it's getting closer, or this is going up or up and down or whatever. But if you look at the period from the start at the end of 2018 to the September or so, the middle of 2000 no, sorry, this is the middle. This is when they started dropping interest rates in Australia. This is US, by the way. This is when they started dropping interest rates on the 4th of June, 2019. We saw our first interest rate cut, and that's around this period of time. So what happened is the market shit itself here, and people were like, Birch, how did you predict an interest rate cut on that day? How did you predict that things were going to happen? And that was by looking at all this information. And as we proceed from the middle of 2019, for the following months up until September 2019, the repo market exploded. So what the repo market is the repurchase agreement. So every day when the banks close, you have interbank settlements between the banks. So you have, CBA owes Westpac $1 trillion and Westpac owes NAB $1 billion, whatever the case may be. The money that's circulating in the back of these banks, and these are like US banks, what happened is that one of them or multiples of them were insolvent and there wasn't enough capital. So the repurchasing agreement came out, and the New York Fed started purchasing hundreds of billions of dollars worth of bonds every day, which were 3-month bonds. And the 3-month bond sucked all the liquidity out of the market. So the yield curve went whoop and flipped over really badly. And then suddenly we've got a virus and we've got lockdown economies, we've frozen all our financial markets, and we saw money printing like never before, and we got out of it. And as we went through, we had a recession here for a period of a couple of months, and then we saw the highs, the separation of the yield curve, and it went back to a positive format. But once they stopped around here, once they stopped the production of fiat cash, like really cash trash sort of money, we saw the market starting to fall again. And we can see here when we spread it out and look at it on a very smaller level, we can see that we had a little dip here, which is what caused the alleged recession that we're meant to have in 2020, which was printed over. And we've just had another one a couple of months ago. This here was caused because they tried to put the interest rates up. This is because they wanted to try and remove the stimulus packages. And I'm betting you that each time one of these packages ended or disappeared is when the markets closed down and went to invert, because there's too much risk in the market. They're going to try and artificially do this, but you cannot maintain a healthy yield on the bond market if you are doing what they're doing at the moment. And for me, that is saying one of two things. They can try and increase these rates as much as they want. I believe that we have a window of less than 24 months. I put all my reputation on the line by saying these things. Within the next 24 months, we will see the interest rates come down. They can put them up as high as they want, but the higher that they put the interest rate up, the bigger the problem that they're going to cause. So they're going to have a problem like this. Are they going to have a problem like this? They're going to have a problem like this. And what is the percentage that we are going to have to see them reduce it? Technically, looking at all the information, interest rate should be 3% right now. If they go to 3%, everybody dies. And just following on with a little bit of repetition from last night's Facebook Live, what will happen is a lot of people think, Rose, I'm going to ask you the question here, just for your feedback, consultation. I've never asked too many people, but I'm only surmising here. Out of the world, we have lots of money that's printed out, their debt, right? We have everybody that's watching this is worried about their debt on their home, right? That's most likely where everyone's watching this. But if we look at the rest of the debt in the world, where is the debt gone? The debt is governments. The debt is big institutions. It is Coles, Woolworths, the trucking companies, the petrol companies, all the large corporations have debt, all the large institutions, all the governments have debt. Australia is now into, when Paul Keating was in 1992, in that recession that he had to have, he raised $96 billion worth of debt. In the last year, 2 years, we have seen $1 trillion worth of debt. So 10 times more debt in the last year than back in the Keating era. What level of debt, what price did the government get the debt at? Their bonds were at 0.5%, 0.25%, right? If the rates go up to 2%, 3%, that means that the government's debt has now gone up 5 times. So if you think you're going to die with your mortgage, the government's going to blow up, right? What percentage would, let's say all the debt out there, would it be, say, 50% debt towards homeowners and 50% towards business, governments and all other, or would it be 80% to business other and 20% to property? Would it be 100% to property and no debt, no business has debt? What would be your thoughts of the percentage difference? Do you think?
I think the mortgages, like property debts, is probably just in comparison to business debts, right? It's probably just, I would envisage around probably 35%.
That's what I guessed out of the top of my head, right? And that's what I'm working on, right? 30% debt is based on mortgages and 70% as business. I just pulled that number out of my head. But let's assume it's 50-50, whatever it is, right? So everybody's mortgages, you've just been talking to everyone this evening about the interest rates at 5%, 4%, 3%, 2%, right? Now, let's go back to those businesses, right? How do they buy their debt? Do they pay 5% for their debt? Or do they do a BBSW with a bank bill swap rate?
I think it's a swap rate, isn't it?
They work on a swap rate.
Yeah.
So go and do some research on a swap rate and what a swap rate really is. What a bank bill swap rate is basically if the RBA is charging 10 basis points, the bank will add a 1% premium to that. So it's 1.1%, right? If the RBA is charging 1% and the bank charges a 1% premium, then that is now 2% interest rate, right? If a business's debt is costing them 10% of their revenue or their profit. Imagine if that doubles next year, right? The cost of business debt and commercial debt, because it's worked on a bank bill swap rate, will double, quadruple overnight. So last night, or the night before, businesses were going to bed and they were paying 1% premium and a 10 basis points, so they're paying 1.1. Now they're paying 1.35%, right? So their rate has gone up 30% overnight, their cost of debt. So if the market's going to shit itself, it ain't going to be everyone watching this, it's going to be in trouble. They might get into trouble, and the most reason why they will get into trouble is because they probably won't have a job, because their business that they're working for, which has debt, is going to go and implode. So then they're going to have to now bail out the businesses, right? There's going to be a whole pile of new stimulus packages. There's going to be a whole pile of reducing of cash rates around the world. So this bond market is dead. We cannot get off zero interest rate policy. My prediction of it is that we could see, I always thought, 2 25 basis point increases, my personal thoughts, and hold me to it as much as you want. I ain't going to stick because I'm just talking shit right now, right? Who knows what's going to happen in interest rates? I don't have control of that. You guys don't have control of it. We're not the controllers of this money and currency creation out there. It is our keepers that are doing that. So when we look at, the central banks around the world controlling the cost of the rates, if they go up 0.5%, my calculation tells me that that's the point where everyone starts getting the shit. If it goes up to 1%, we're going to see a bigger recession and we're going to see a bigger problem out there. If it goes up to 2%, and just remembering, interest rates were 1.5% for 6 years, right? 6 years,
since
less than that. No, since about 2016 or so, 2017, interest rates have been 1.5% or less. And they've dropped for the last 2 years, 3 years, 3 years it's been now. The interest rates have dropped to less than 1.5 because they fell down in 4th of June. So if the interest rates went up to higher than what they were 6 years ago, and if we pulled out a chart that showed what yields look like, they never go back to the old all-time highs. But if it does go up, however high it goes up, it's going to have to come down far greater because there's going to be such blood on the street, and they're going to have to turn the course of action around very, very quickly. So my prediction is that it will not last more than 24 months, and I think we'll probably tap out over about 3 months or 4 months, and we're going to start seeing big recessions around the world. We're starting to see in other countries, we're seeing the yield curves inverted. We're seeing a lot of things that are going pear-shaped. You can sit there and get an education lesson from watching the news, which are just a whole pile of fucking puppets that are placed there. I always question, who are these people? I've been in the media, I've been on TV over 100 times. I see the things I can say. I could never say anything like this on TV because I'll get shut down, and it's against the advertiser's position on there. I share this information because I hope and I know that in periods like this, I'll do very well out of it, and people will be like, oh, wow, Nathan, thanks a lot for your advice, and that's where I do well and I shine. I don't need to go and be a product and be put on TV. And I see all these avatars that are out there, and they're puppets, right? And you can say this, you can say that. They've got little things that they can read and scripts and dialogues, and I just say things as they are, and I try and deliver you guys as much sort of content and insight and things that are really controlling this. It's not just because people are like, oh, wow, we've got some inflation, and they create division around it. It's like, you fucking idiots, right? Like fucking idiots that are putting this dribble out of their mouth, creating division, creating scarcity and fear mongering, whatever. If you couldn't afford your property 2 years ago at 1.5% interest rate and it's currently at 35 basis points, well, then you probably didn't have a right strategy to start off with, and you haven't protected yourself from a cash flow, and you're a time bomb. There will be lots of people that will blow up, and it will be those people that are our saving grace, because those people will explode, and they'll be like, oh, wow, we need to help these people, right? And when we come along and help those people, all of us that have protected ourselves well, had a good sound strategy, had good debt, had a position of, making our calculated decisions, we will get really protected with all the benefits that come to all those people that were idiots in this party. So on that note, that's just my 2 cents. I think interest rates should go up maybe about 0.5% and then come back down. They could go up to 1%. Any higher that they go between 0.5% and 1%, we're going to see so much fun on the other side of this. It might be pain for 12 months, might be pain for 24 months. I'm hoping that my jovial excitement about this isn't pissing people off, because people are like, oh, my interest rate's gone up, it's hurt me, and all that sort of stuff. You need help, reach out to us. We're here to help. But you know, as an investor, you're not speculating, right? You shouldn't be looking at 2 months or 6 months or 12 months or 2 years. You need to be looking at your big term goal and your overall picture of what your strategy is, where you are today, where you're trying to head to in the future. All of these things are expected. There's always a gatekeeper to help you, to stop you from trying to get to the next level. Most people get their ball, get the shits, pack up and go home because they're scared, they're upset. And I love that, right? Weak hands, give me your weak hands, right? Weak hands lose assets. Strong hands hold assets. Strong hands gain assets. You've got to make a decision. Where are you? Do you have weak hands? Do you have strong hands? Go follow the crowd, or go make educated decisions. Research yourself, arm yourself with knowledge, and make those decisions.